Good afternoon, all. Thank you for being punctual after lunch. I guess a few degrees lower temperature helped to bring you back. But much more important than that is our keynote speaker. I'm really honored to chair this session. Claudio is my former colleague and head of department, monetary economic department at the BIS. Claudio was at my farewell party a year ago when I retired from the BIS. And Claudio himself then retired a few months ago at the end of last year. Claudio, I don't need to say, has been a spiritus movens behind BIS view over the past few decades. And the paper that he will present is a perfect type of keynote that we like at this conference because it casts a broad net and looks back and looks forward, in this case at inflation targeting, the monetary framework that has dominated policy making in central banks since the late 1980s. So Claudio, floor is yours. Thank you.
Well, thank you, Dubravko, and thanks to the organizers generally for inviting me. As Boris was saying, you've been inviting me for a long time, and I always said no because of the annual economic report, but finally, after retiring, I can do this. The other, I think, preamble is that my presentation has nothing to do with global supply chains and the great reallocation, so I don't know what the title is there, but I hope I don't have to talk about that, because then I would have some problems. Now, rather what I would do, I intend to do, also following suggestions with the organizers, is to share with you some personal reflections on monetary policy based on my long career at the BIS, more than 30 years. What I thought I would do is to stand back and provide a personal perspective on the success and limitations of what has really become the de facto global monetary standard, and that is inflation targeting. Key takeaways from my presentation, I would say basically two, really. First, inflation targeting has achieved what it was designed to achieve, which is to help deliver an era of price stability across the world, and that's no mean feat, because we know that price stability is a precondition for longer-term prosperity. And second, and however, this is the however part, I worry that to be fit for purpose longer term, it needs to adapt in ways that probably do not figure that prominently in the current debate. And by that I mean more systematic consideration of the long-term damage that financial factors can cause to the economy, more systematic consideration of the importance of safety margins in the operation of policy, and all this grounded on a, I would say, clear recognition of what monetary policy can, and above all, cannot deliver. So the roadmap of my presentation, I'll briefly recall the success story, which is really not the controversial part. I will then move on to probe some of the limitations, and this is the more controversial part of my presentation. I will finally then propose some refinements based on that. By the way, I don't have any graphs here, nor a written sort of set of slides, but there is, of course, a written presentation which is full of slides and full of graphs, and which tries to provide some of the background evidence for some of the things that I will be saying. But effectively, these are things accumulated over many years of work with colleagues at the BIS. So let me start the journey with a definition of inflation targeting. And I would say for the current purposes, I will basically use three key features. First of all, numerical targets for inflation. Second, doing away with intermediate targets, such as credit, monetary aggregates, or even the exchange rate. And finally, a supporting communication strategy to strengthen transparency and accountability. Now, looking back, inflation targeting had a hesitant and I would say inauspicious beginning because it had really been adopted by countries that had tried everything else and it hadn't worked. So I'm thinking of New Zealand, Canada, and the UK. It was a little bit like, if you want to be uncharitable, which I won't be, you could say that it was out of desperation. Now, moreover, compared with inflation targeting strategies, it certainly represented a certain leap of faith. I remember at the time the whole debate in monetary economics was about how to achieve a given inflation objective, if you like, given the loose link between instruments and final objectives, so the control problem. Now, inflation targeting, in contrast, basically did away with these intermediate objectives, exchange rates, monetary aggregates, whatever, and was silent about these issues. It was basically postulating a direct and stable link between your instrument, your short-term interest rate, an overnight rate, and your ultimate objective, which is inflation. Now, prima facie, you could say that it was a case of if you cannot will the means, well, will the ends. Now, despite this inauspicious beginning, inflation targeting has clearly gone from strength to strength. It has been adopted widely across the world. It has passed what I would define as the no-regret test. That is, no country has abandoned the regime after having adopted it. And judged by its explicit objective, it has been a success story. Inflation is generally stable, has been generally been stable across the world, and central banks have been able to bring it down following the surprising surge post-COVID. Now, to be sure, circumstances did help along the way, and we'll say more about that in a minute. But I think that the role of inflation targeting in hardwiring a low inflation regime, I think it's undeniable. But what about the challenges that inflation targeting has faced over this long period? The key question that I think we should all ask is to what extent those challenges are exogenous to the regime itself, or at least in part the result of how the regime has been operated. And I think forming a view about this key question is essential if one wants to identify refinements going forward. Now, my thesis is that some of the challenges are in part the result of the specific regime's operation. And I will focus on two. One is the great financial crisis, and the other are the difficulties in pushing inflation back to point targets following the great financial crisis. And connecting these two challenges is what I would call a historic loss in the room for policy maneuver that monetary policy has suffered even before the COVID crisis struck. We know that in nominal terms, interest rates had never been as low, indeed in negative terms, in negative territory, since records had begun. In real terms, they had been negative for even longer than what they had been during the great inflation era. And central bank balance sheets had reached peaks previously approximated only during wars. Now, the COVID crisis simply exacerbated this condition. So let me say a few words about each. First of all, the pre-great financial crisis phase. Now, when inflation targeting was first adopted, people worried very much as to whether it would be able to withstand negative supply-side shocks. Of course, these are the shocks that create the trickiest political, economy, and economic problems for central banks because we know they raise inflation and reduce output. Instead, actually, I was more concerned with threats coming from the financial side. In particular, I was worried about financial instability, and in that context, about positive, not negative, but positive supply-side shocks, or better put, positive supply-side forces. So why my concern? Well, as inflation targeting spread, the economic landscape was fundamentally changing in the wake of deeper policy-induced tectonic forces. On the one hand, financial liberalization was providing bigger scope for disruptive financial expansions and contractions, what I would call financial cycles, that is, the self-reinforcing shifts in credit, asset prices, and risk-taking that create expansions that are actually subsequently followed by contractions. And on the other hand, the globalization of the real side of the economy, and we heard a little bit about that before, this positive supply side force had started blowing powerful disinflationary tailwinds across the world. Think of the integration of former communist countries and China into world trade and the opening up of emerging market economies. This was adding a huge number of lower-cost workers to the world's effective labor force, transforming the wage-price nexus, which is the real engine of inflation. Now, in that context, let me stress, in that context, the inflation targeting regime could inadvertently accommodate the build-up of financial imbalances, because there would be no incentive for monetary policy to tighten as long as inflation remained under control, especially since inflation targeting dispensed with any quantitative aggregates or quantitative intermediate targets. Indeed, if you look closely at the data, in fact, you don't really need to look at it that closely. A subtle change in the nature of the business cycle was taking place starting in the mid-1980s, from what I would call financial inflation-induced to financial cycle-induced recessions, at least in advanced economies. What I mean by that, until then, the typical trigger of a downturn was a monetary tightening to quell inflation. In the meantime, indicators of the financial cycle were not really moving that much. Thereafter, inflation would not increase that much, which meant that monetary policy would not have to tighten that much, but very large financial expansions were giving way to financial contractions. And of course, the great financial crisis is the most spectacular case, but if you look at the downturns of the 1990s, they were already qualitatively of that nature. I'm thinking of the full-blown crisis in the Nordic countries, or indeed of the banking strains in the United States. So put differently, inflation became an unreliable signal of the sustainability of economic expansions. The buildup of financial imbalances was taking over that role. Now, importantly, the unreliability of inflation as a signal was, of course, also transmitted, if you like, to R star. Precisely at the time when R star was inevitably rising in policy making as intermediate targets had been abandoned. Now, we know that R star is defined as the short-term real interest rate, which is consistent with output potential, and inflation stable, therefore typically at target, absent business cycle disturbances, that is in steady state. So a common practice at the time, when inflation turned out to be lower than expected, was basically to raise estimate of potential output, and therefore to reduce estimates of the natural rate, which meant that if you wanted to keep the monetary policy stance constant, you had to reduce interest rates. Now you can see that over time, over successive business and financial cycles, this could actually reduce the room for policy maneuver. Interest rates would tend to fall, financial imbalances would tend to increase, and then these financial imbalances would ultimately usher in financial cycle recessions, financial instability, financially induced downturns, which tend to be deeper and whose recoveries from are actually lengthier, which meant that interest rates had to be lower than for longer as the debt overhang was absorbed and the capital misallocation corrected. Think of the big booms in the property markets. So in this sense, you could see how low rates, in a way, could beget lower rates. What about the post-GFC phase? Well, in the post-GFC phase, I worry in particular that over-reliance on the concept of R star could actually further reduce the room for policy maneuver. And this paradoxically, as a result of attempts to regain that room for policy maneuver. Remember, this was a key consideration in the review of policy frameworks. And here the notion that R star is exogenous to monetary policy is key. Because if the equilibrium real interest rate is exogenous, entirely exogenous, then the only way to regain room for policy maneuver on a durable basis is to raise inflation. That means reducing interest rates today in order to be able to raise them in the future, which means losing room for policy maneuver for certain today in the expectation of regaining it in the future. Now, you could see the risk of this strategy is that if inflation does not respond sufficiently to monetary policy, you would end up losing as opposed to regaining that room for policy maneuver. Now, as it turned out, central banks did struggle to push inflation back to point targets, even as the economies recovered. Although, importantly, I think the shortfalls always remained contained within a handful of basis points. Moreover, concerns about the de-anchoring of expectations and ultimately deflation provided an additional reason to push harder. Now, I see at least two reasons why central banks struggle to push inflation up. First is that the impact of easing of monetary policy on aggregate demand may exhibit diminishing returns after a certain point. After all, if the textbooks are right, monetary policy mainly operates by bringing demand from the future to the present, and surely there must be limits to that process. Moreover, more prosaically, if you like, low for long interest rates tend to sap back bank profitability and therefore banks' credit generating capacity. And there is considerable evidence, I think, to that effect. Now, the second reason is that inflation may respond less to aggregate demand pressures when inflation settles at a low level. Now, one possible explanation, which is very specific to a period that we saw, is that the globalization tailwinds turned into headwinds when central banks were trying to push inflation up. But a more general explanation, and I think this is the more important point, has to do with the inherent properties of inflation in a low inflation regime. So let me develop that a little bit. Now, recent work with colleagues, and Marco is one of them, has confirmed that inflation behaves very differently in low and high inflation regimes. In a low inflation regime, inflation exhibits some certain self-stabilizing properties. That's because what we measure as inflation is largely the result of a myriad of idiosyncratic or sector-specific price changes. That is, the common component of price changes is quite low. And because of their very nature, these changes tend to leave a little imprint on inflation. In addition, the link between wages and prices tends to be quite loose. Now, what's the underlying reason for all this? Now, the explanation that I personally find most appealing is that when inflation is low, it does not materially influence people's behavior. That is, economic agents, and by here I mean specific, not so much financial markets, but I do mean labor and firms, become rationally inattentive. And I will come back to this. By contrast, in a high inflation regime, no such self-stabilizing properties are at work. The common component of price changes is higher, and wages and prices tend to be more tightly linked. So that shock to sector-specific prices tend to turn into persistent inflation much more easily. Now, critically, the fact that the small common component of price changes when inflation is low reduces the responsiveness of inflation to adjustments in the monetary policy stance. And that is because intuitively, changes in the stance work precisely through that component, which is the one which is more closely related to aggregate demand and to exchange rates. And again, there is quite a bit of empirical evidence that confirms that very simple intuition. So to recap, central banks' reaction function in inflation targeting regimes has arguably contributed to the progressive loss in the room for policy maneuver before the COVID crisis. At each point in time, what central banks were taking as an exogenous interest rate was, in fact, to some extent, the result of their previous actions. So ultimately, and I was concerned about this was raising the risk of a debt trap, whereby interest rates would decline over time. This is the trend. Debts would basically go up, and this would make it harder for the central banks to raise interest rates without creating problems for the real economy. Now, all the more so if we consider what was going on with the public sector debt as opposed to private sector debt. So this is not the financial cycle as such. So even pre-COVID, government to debt GDP ratios had reached historical peaks across much of the world, in line with the previous Second World War peaks. Now, the financial cycle had a lot to do with this too, and I won't go into that, but basically sort of raising, giving the appearance that revenues were much stronger than they actually were. But as did also, an important factor here was the belief that interest rates would remain low as far as I could see. Now, it took a huge exogenous shock to jolt the system away from its path, at least temporarily. Now, to be sure, first central banks and governments had to consume further the room for maneuver they had at their disposal to deal with the COVID crisis. But then, the unexpected surge in inflation induced a welcome and forceful monetary policy tightening. So central banks did regain room for policy maneuver, but at this time, necessarily, given what was going on with the public sector debt, at the expense of governments, which basically saw their interest rate bill balloon. Now, the key question going forward, therefore, is whether interest rates will settle as inflation is brought back under control. Where will they settle? Now, if the analysis is correct, this will partly depend on any further evolution in the inflation targeting regimes themselves. Now, at this point, I'm pretty sure that many of you, if not all of you, are asking, well, what about the evidence that R star is determined by fundamental, slow-moving forces, productivity growth, demographics, income distribution, and the like? I mean, we know what I would call the usual suspects. Well, I think my answer is threefold here. First, the previous analysis suggests that monetary policy can easily have a very persistent impact on real interest rates through its impact on financial stability, on the financial system, which for all intents and purposes, are indistinguishable from an impact on R star, given how long they last. Second, empirical evidence is not as strong as it is normally believed. When data are allowed to speak, there is really no much evidence of a systematic link between the usual suspects that I mentioned earlier and real interest rates before the mid-1980s. And in fact, if the sample is extended back to the 1870s, a robust relationship emerges with respect to monetary policy regimes across time and countries. And finally, this suggests to me that the link between real interest rates and output at potential on stable inflation is not really as tight as it is normally believed. Broader aspects of things like financial conditions and actually the level of nominal interest rates themselves come into it and basically sort of cloud the picture. So if you like, my hypothesis is that a range of real policy rates can be broadly consistent with such outcomes, even over extended periods. So from this perspective, the very large confidence bands that we see around R star may not so much reflect the fact that a precise relationship is measured imprecisely, but rather the relationship itself is imprecise. So what about possible adjustments to the inflation targeting regime? Now, if you buy this analysis, what could those be? I think that any such adjustments would need to take into account a number of considerations. So let me mention 4 here. The first is that the framework needs to be robust to alternative possible economic environments. And I have a sense that not all the changes that we saw after the COVID crisis took that form, and I'm thinking also in particular of what happened at the Fed. Arguably, in the years ahead, the world could be structurally more inflationary. If deglobalization takes hold, then labor and firms could regain their pricing power, geopolitics, the green transition, and demographic trends may raise more persistent headwinds, and high levels of public and also private debt can provide greater incentives to inflate them away. So these are very structural forces. But one cannot rule out a return to the pre-COVID environment. Inflation is returning back to low levels, and wage pressures have so far been remarkably subdued, I would say, given the erosion in real purchasing power that took place, surprising erosion in real purchasing power that took place during COVID. By the way, in Switzerland, we're already talking about negative interest rates again, so we're back where we started, as it were. The second consideration is what I would call the importance of long policy horizons, which I don't think I could stress enough. We know that long policy horizons are already commonplace and important in the context of inflation control. Recall the temptation to boost output in the short run, but at the expense of higher inflation longer term, this form of time inconsistency. But then the financial cycle can raise a more insidious form of time inconsistency. And that is because the financial cycle tends to be much longer than how the business cycle is traditionally, let me stress, traditionally measured, the kind of statistical filters that we use for that, which, and by some estimate, is about twice as long. It is as if the emergence of the financial cycle had slowed down economic time in relation to calendar time, so that the time that the economic forces that really matter effectively play themselves out over a longer period. But in fact, actually applying statistical filters similar to those that we normally apply to output, to the financial cycle, to output, actually reveals that there is also a medium-term business cycle that moves remarkably in sync with the financial cycle. And I think that we haven't done enough work in that area in general. Third consideration, I think it's the need to incorporate systematically the importance of safety margins or buffers in the conduct of policy, because economies operating without safety margins are vulnerable to both the inevitable next recession and to unexpected shocks such as the COVID crisis. Now, in all walks of life, the need to retain safety margins is an explicit guide to action. Why should really it be different from monetary policy? Now, if something is valuable, one should be willing to pay a price for it. And the final consideration, I think that it's essential to have a realistic view of what monetary policy can and cannot deliver. As long as it is prepared to pay the price, monetary policy can bring inflation down and avoiding it becoming entrenched. As long as it has fiscal backing, monetary policy can stabilize the financial system at times of stress, even if solvency is at stake, in playing its traditional role of the lender of last resort and increasingly market maker or buyer of last resort. And as long as prudential policy is supportive, monetary policy can help to restrain financial imbalances and constrain their damage. But monetary policy cannot fine-tune inflation within basis points, and let alone economic activity within narrow ranges, nor can it be relied upon indirectly or de facto as an engine of growth. Now, when I see the financial industry and media razzmatazz surrounding policy decisions, I worry that we have long lost that sense of realism. And I see a dangerous gap developing between an expectations gap between what monetary policy can deliver and what it is expected to deliver. This clearly can complicate policy, but ultimately it could even undermine central banks' independence and their legitimacy. Now, these broad considerations have implications for the objectives and strategies to pursue them, and for symmetry, let me just mention four. First is that the first implication is that we need to hardwire a low inflation regime, and that should remain a priority. I love the behavioral definition of price stability that Volcker and then Greenspan gave for the reasons that you heard before, which is an environment in which inflation does not materially influence people's behavior. So let me stress, the objective should not be so much stabilizing inflation expectations, but actually making them irrelevant. And I think that when you are operating in a low inflation regime, the expectations of those people that really matter for inflation ultimately, households, firms, workers and firms, inflation for them becomes largely irrelevant. Now, this also means, by implication, that the idea of raising current targets would be a bad idea. Now, quite apart from undermining central banks' credibility, the usual argument, it would endanger this low inflation environment and hence also the self-stabilizing properties that inflation has in such an environment. Inflation drifting out of the region of rational inattention into the region of sharp focus. And then it could also act as a more effective coordinating device for people's decisions. Because remember, as the common factor of price changes actually increases with inflation, those price changes become more similar. So that the inflation becomes more representative of the price indices that each of us as producers or as consumers are facing. Now, critically, this is one reason, not the only reason, but one reason why transitions from low to high inflation regimes tend to be self-reinforcing. The second implication, key adjustments, would be to have greater tolerance than in the past for moderate, even if persistent, shortfalls of inflation from narrowly defined targets. This would help retain the precious room for maneuver that I was talking about before, exploiting the self-stabilizing properties of low inflation regimes, and would allow central banks to take more systematically into account the longer-term damage caused by persistently low interest rates. Now, implementing such a strategy would require addressing also the so-called deflation bogeyman, as Feldstein and Rajan put it. Seeing deflation as a kind of red line that, once crossed, generates self-reinforcing downward spirals in economic activity or a depression trap. Neither empirically nor conceptually is the link as strong as often believed. Third implication, further thought should be given to how best to use the additional room for maneuver that I mentioned earlier to tackle the financial cycle. I have no specific answers here, but just a general direction of travel, lengthening policy horizons as far as possible, upgrading the role of financial conditions, particularly credit aggregates and property prices, in policy making as guides to policy, and analytically, I would say, a paradigm shift in the way that we think about the business cycle, away from the shock, propagation, return to steady state paradigm, to one that sees endogenous fluctuations are being the essence of business cycles, endogenous fluctuations that can be potentially unstable as a result of the role of financial factors. And the final implication is to adopt further adjustments designed to preserve or increase the flexibility and safety margins. And here I would just mention two. One is less reliance on forms of forward guidance that provide specific information about the interest rate path beyond the central bank's reaction function, which can unduly constrain the central bank's nimbleness, and also unduly compress risk premia and therefore encourage risk-taking. And putting a premium on exit strategies whenever central banks take exceptional measures to stabilize the system and the economy. Think of the difficulties that central banks have been facing in reducing the historically large and risky balance sheets they have. I think that a reasonable principle here would be that central bank balance sheets should be as small and riskless as possible, subject to fulfilling, of course, central bank mandates effectively. But to my mind, except possibly for the need to hold foreign exchange reserves for precautionary purposes for some countries around the world, balance sheets can be very, very small. Central bank balance sheets should be elastic, ready to increase when circumstances require it, and not large. And given the economic and political economic cost of large balance sheets, the initial size is a hindrance, it's not a plus. So what kind of regime do I have in mind? Well, it's one where the central banks keeps a sharp focus on the medium term, seeking to ensure that the financial side of the economy which it influences, the central bank influences, and through which it operates, does not end up derailing the economy through inflation or the financial instability, broadly defined. So if you like, central banks should simply set the monetary preconditions for sustainable growth, but that do not end up being relied upon as the engines of that growth. A regime where the operational definition of the inflation target is consistent with that overarching objective, that is low enough so that inflation does not materially influence people's behavior, but flexible enough to allow the central bank to take into account the financial forces that can generate longer-term damage to the real economy. And a regime where the central bank's reaction function calls for forceful responses when inflation threatens on the upside because of the self-reinforcing nature of the transitions to high inflation, but allows for greater tolerance for moderate, even if persistent, shortfalls of inflation from target. And this goes back to the self-stabilizing properties of inflation and the deflation bogeyman. So, a couple of concluding reflections here. Looking forward, I do worry that the toughest challenges for monetary policy and indeed for inflation targeting are still to come. For one, the political environment is becoming less conducive to a stability-oriented monetary policy. There are growing pressures on the central banks to take a short-term view, and the demands on them are growing. In such an environment, institutional safeguards such as central bank independence become all the more precious, but of course they can only help you up to a point. Moreover, I would not take too much comfort from the recent rather painless reduction in inflation that we have seen. I think circumstances were simply extraordinary, and I believe the future fights are likely to involve bigger costs, as they did in the past, especially if the world becomes less globalized, and if firms and workers in that world regain their purchasing power or their pricing power in general, so that we see greater resistance to the erosion of purchasing power and compression of profit margins. In addition, and closely related, the sustainability of fiscal trajectories is a major threat. As we actually said in the annual economic report a couple of years ago, probably the biggest long-term threat to macroeconomic and financial stability in the years ahead, in the medium term, and therefore ultimately a threat to the inflation targeting regime itself. Monetary and fiscal policy are joined at the hip, and there are clear limits to what monetary policy can do if fiscal policy is out of kilter. Both policies have to operate, if you like, in a certain region of stability, which is consistent with sustainable growth. Now, by the way, these threats are also likely to make the adjustments that I proposed even less likely. I'm clear-eyed about that. But I think that inflation targeting regimes cannot stand still. Inflation targeting does not represent the end of monetary policy history, as it were. It is just one, if exceptionally long, chapter in that history. Thank you very much.
Thank you, Claudio. To help us kick off the discussion, we have two excellent colleagues to introduce to what they think about this range of topic. So first, Vedran Šošić from Croatian National Bank, Chief Economist of the HNB.
Thank you, Dubravko. Actually, Thorsten got scared when there was a different title of the paper, and Claudio was sure what he's going to present. And there was a bit of a mix-up with me also when someone tells me to provide introductory comments. I usually assume that it's before the speech and that it needs to contain as few spoilers as possible. So I had a version of the speech with no spoilers, almost no spoilers whatsoever. But during Claudio's speech, I have added a few spoilers, which are not spoilers after the speech. So Dubravko said that Claudio spent decades at the BIS, and actually those are almost 4 decades, if I just to make it clear. And for BIS, if you ask ChatGPT about BIS, ChatGPT would say that BIS is an institution that you need to visit after you get a diagnosis from the IMF to get a second opinion. And this second opinion that you get from the BIS is not something that you want to see, but you certainly need to see this second opinion. And also, ChatGPT would say, even in a bit more poetic fashion, that BIS is the place where economic orthodoxy goes not to die, but to be gently, thoroughly, and respectfully interrogated. And Claudio is very central. We heard that he was very central on making BIS such an institution, and he did repeated such a feat today again on inflation targeting. So for those who did not guess, now you know, inviting Claudio to speak about inflation targeting here is a bit like inviting Nietzsche to a wellness retreat. So you know it won't be light, it won't be easy, but by the end, you'll probably question your entire belief system, and maybe your inflation target too. Now our romance, the central bank's romance with the inflation targeting regime has had its rocky moment. Claudio said that we had ups and downs, and he particularly mentioned 2 moments, the financial crisis and more recently when inflation decided to make a dramatic post-pandemic comeback. But like any good codependent relationship, we kept patching things up and pretending that everything is fine. And Claudio is not here to recommend us cosmetic fixes. He is asking whether it's time not to stop applying patches and to consider a full relationship rethink with inflation targeting. So he wants us to zoom out, to look beyond the short term, to confront whether our very elegant, intellectually elegant, but occasionally a bit not fully functional monetary framework is due for some, in his opinion, long overdue therapy. And as always, the central elements of his financial cycles, macro financial imbalances, and always looking through the long-term lens. And brace yourself for this. He even dares to question the 2% inflation target as the monetary version of nirvana. So he thinks that it's more or less just a number we all agreed upon because it looks very nice in our communiques. His talk was especially well targeted for central bankers because we know that central bankers that attend the Dubrovnik conference, they fall squarely into the Marxist camp. Of course, not Karl Marx, but Groucho Marx, as Groucho Marx famously said, and Randy keeps reminding us each and every year, those are my principles, and if you don't like them, well, I have others. And Claudio is, central bankers care about their principles, and in this Groucho Marxist fashion, Claudio offers us a wholly fresh set of principles, which are intellectually sound, policy relevant, and probably annoying to many of our orthodox colleagues. So this was not a gentle policy talk with bullet points and Basel III footnotes and 0 surprises. So our assumptions about monetary policy framework got poked, prodded, politely dismantled. So just to add a bit more on my introductory remarks, I want to say that Claudio's ideas are slowly gaining, some of his ideas are gaining traction. For example, the idea that R-star is endogenous to monetary policy. Isabel had a speech about a year ago, Rising Star. She quoted Hildebrandt' paper from 2023 and also quoted a different paper from Claudio. And Hildebrandt basically concluded that long-term interest rates adjust mostly around in a very short window around the Fed meeting. So basically they adjust on after the central bank says what it thinks, and then financial markets adjust their long-term view of the economy. And with the ECB, I think it's not. I guess you have repeated the exercise, and you did not find similar relationships. At least we didn't find anything similar. The second very important element for me is the complementarity between monetary and macroprudential policy. I mean, initially the macroprudential policy was set up as a wholly independent policy with this independent goal. And for us, for example, is Croatia, it was not a new. I mean, for us, the monetary and macroprudential policy has been integrated even before we knew that it was the macroprudential policy was called the macroprudential policy. And this is seeping in more and more into mainstream thinking. For example, ECB in the last monetary policy review 5 years ago acknowledged these links, and now it has integrated some of these spillovers between monetary and macroprudential policies in the policy framework. IMF is even more advanced with the integrated policy framework. So they very specifically look at spillovers between monetary and macroprudential policies. And as some of the advanced economies become more like US, for example, becoming a bit more like emerging market economies, the central bankers' thinking may move a bit further into this direction. So we may start to thinking about more and more about monetary macroprudential policies as complements. What I don't like is the notion that structural factors are not important for R star. So that's something that I like a bit less. We know there is a research about the impact of demography on R star. It shows that the relationship is very complex. It's non-linear. Even if you hold everything else constant, and we know that everything else is not constant. For example, as our life expectancy increases, older people start to save more and more. So this is a very dynamic relationship, and I would advise not to ditch any attempt to understand determinants of R star, but rather to try to better understand these factors, including the balance between exogenous and endogenous determinants of R star, endogenous and exogenous to monetary policy. For some ideas, it may be even harder, for example, to abandoning point targets. Fed now has some flexibility, the making up in their strategy, and their comments have not been seen very favorable, this making up strategy. So I think they may be even moving further to point targets. So the central banks may need a bit more persuading to start thinking about point targets. Also, Claudio touches upon our modeling framework, and we are thinking hard on how to improve our modeling frameworks, our models. We know that they are less than perfect, even given what we have experienced over the past 5 years, that there may be ways to improve. So we have some things in our shopping cart. For example, we have Hank models, heterogeneous agents models, which are more complex, which can give a rise to nonlinear dynamics. We have Borio satellite models that we use to cross-check our workhorse models. So I would say that Claudio is knocking on open doors on the improvement of modeling framework. And just one more point on balance sheets. Well, we all know that profitability is not a key goal for central banks, but it may get harder and harder to accomplish for us. For example, if demand for cash substantially decreases with the advent of non-cash payments, so we are in our seniorage on cash. So then if we move into on a more permanent basis into negative profit and loss account, then we may really start to think of that profitability is important for us. So that's it. So thank you, Claudio, for nice.
Thank you, Vedran. And Thorsten, next, please.
Well, thank you very much. So someone, and it was not Groucho Marx, once said that preparing a conference discussion is a little bit like preparing a sandwich. The easy part are the 2 slices of bread, because you start a discussion by praising the author, you end the discussion by praising the author. The tough part is the filling of the sandwich, or the panino for you, Claudio. What do you say in between the beginning and the end of the discussion? And here I initially struggled a little bit because I'm not a monetary economist. I'm not a macroeconomist. And I'm not going to discuss R star. I'm going to mention it once. But what I'm going to do is I'm going to talk a bit about finance, because I'm a financial economist, so I guess that's what I can do. Now the first, and again, to start, of course, saying that I really, really enjoyed reading this paper. It's not an academic paper, like I would normally read, but it's a paper that takes stock. It takes stocks and kind of makes this very strong point that in order to be prepared for the present and for the future, you need to learn the lessons from the past. And I think that's what I also took away from it. Now, reading the paper, I kind of felt to a certain extent, especially when it comes from the move from what you could describe as business cycles to financial cycles, has inflation targeting been a victim of its own success? Let me explain. So we know that during the same period as with inflation targeting became successful, although actually a little bit earlier than that, there was also something called financial liberalization. So in the 80s, 87, London, for example, Big Bang, then also in the US in the 90s, the financial sector really expanded rapidly. And of course, there was a lot of deregulation, which was one big reason, but maybe also because inflation targeting ultimately achieved its goal of stable inflation, that also enabled long-term financial contracting. I mean, that's at least what we sometimes teach our students. So that is kind of and I guess it's a bit also where the endogeneity comes in. And now I'm going to mention this once, when you mention the endogeneity of R star, I guess I could mention also the fact that we had these financial boom and bust is to a certain extent also endogenous, because we know that monetary policy, and I'm sure you have written about this too, does have an effect on financial stability, on risk-taking. There is this whole literature now about the risk-taking channel of monetary policy, basically explaining how in the run-up to 2008, to the 2008 crisis, low interest rates basically fostered or fueled banks to take more risk, lend to riskier borrowers, lend bigger, and take more leverage, this kind of chase for yield. The other thing that I still remember, I'm not as old as you, as Claudio, of course, but I do still remember that in the early... yeah, I know it doesn't look like, I look like as old as him, but I'm not, okay. I still remember that when in the early 2000s, when The Economist every year, the magazine The Economist every year predicted the financial crisis in the US, and eventually they got it right. The one thing that they also pointed out already was that the monetary policy back then, inflation targeting, did not take into account asset price inflation. And that was a big discussion back then, I remember that. There was, of course, the other thing, which was called a Greenspan put, and then turned into a Bernanke put, and so on. You know, with every new Fed chair, the put gets a new name, a new first name. And of course, this link between, number one, not taking into account the asset price inflation, and providing this put, kind of promising to mop up the mess afterwards, so the moral hazard part of it, of course, that also kind of contributed ultimately to what we've seen in 2008. So that's one, and so you could say, so my explanation is not that you focus on R star, I was supposed to mention it only once, but it's also about this kind of more limited focus of inflation targeting, I guess you could argue, or not taking into account the risk-taking channel of monetary policy. Now, on the other hand, the post-global financial crisis, so in Europe, I mean, it wasn't a deflation bogeyman, I would say, but I think there was an aggregate demand problem. And I think one of the problems was certainly that there was not a proper transmission of monetary policy, because the banking system in some European countries was in a rather bad shape. And I think it's a country that both of us, well, you more than me, know relatively well, among others. So I think, again, I want to kind of focus here really on the financial stability side, that might also take a role of why it hasn't always worked as it was supposed to work. Let me maybe one more remark before I go to my next set of comments. Yes, going forward, I mean, we have now new types of shocks, and basically it started with the pandemic. Of course, then the invasion of Ukraine by Russia, energy price shocks, and so on. And of course, with also the climate change, maybe the demographic change, there might be a tendency towards higher inflation, actually. So this whole more shock-filled world or polycrisis might, of course, also kind of introduce an upside risk to that. Now, Vedran has already taken a little bit away my punch line by mentioning macroprudential policy, because I would have expected actually, Claudio, that you would mention it, because if you think about monetary and financial stability as two goals that are not completely correlated with each other, then according to the Tinbergen rule, we also would need another tool, and we know that microprudential supervision, regulation supervision, is not sufficient for that. So I think there the macroprudential policy, and I would very much like to get your view on that, I think can have a very important role in terms of kind of dampening somewhat the financial crisis, or maybe make the damage, mitigate the damage that I mentioned earlier by caused by inflation targeting. I don't mean this not seriously, but ironic. And I think, I mean, we're talking, of course, mostly here about the time series dimension of macroprudential policies, or the countercyclical capital buffer, and the kind of, reducing the financial cycles. Now, there, I think we still have to learn a lot, because it's, at least here in Europe, it's still relatively new, the macroprudential policy. And of course, we also learned that it might work very differently when a financial cycle is kind of endogenously caused, so between credit boom and bust, rather than responding to an exogenous shock like the pandemic, for example. Now, here actually, let me also mention, coming back to these unconventional risks, I think also the next challenge for financial stability and ultimately also for macroprudential policy will be these new types of shocks that we are increasingly seeing. So because, of course, the macroprudential policy framework that was put in place in Europe, as any regulatory reform, was in response to the previous crisis, not fighting the next crisis. But now we're seeing these new types of shocks, or again, you can call them supply-side shocks. And actually at the European Systemic Risk Board, we're doing some work exactly on kind of how to model it, how to think about these risks and how they can influence the financial system. The last comment I'd like to make is you kind of mentioned this en passant at the very end, but I think it's a very critical point. It's something actually we discussed briefly over lunch. I think inflation targeting as a necessary condition has the independence of the central bank. And I think that is where, I mean, on the other side of the Atlantic, that's clearly under threat right now, I would argue. It's a broader question, not just... I mean, we've seen also in other countries, of course. Turkey is the best example, I would say. Here in the euro area, we're kind of, I would say, blessed because we have I guess, the most independent central bank in the world. Do we? I'm not sure, Isabel, whether you would agree. Yes. It's pretty independent, I would say. So there is no immediate threat, but there is a threat, I would also say, from populist politicians that kind of want to attack the ECB for all kind of reasons. In the euro debt crisis, because ECB was actually sitting on the wrong side of the table. It shouldn't have sat with the IMF. Was also a crisis manager suddenly. Or in Germany because the interest rates were too low, or next time it's going to be again maybe some southern countries, or who knows who's going to complain about them. So constant attacks against, political attacks against the credibility, can also undermine the credibility of a central bank, I would argue. Not to mean, of course, there's a degree of accountability. So, of course, on the other side of the Atlantic, the independence is much more directly under threat. And here, I would say this might also might be a challenge for the future of inflation targeting. How do we think about this in a world where there is, number one, much more of these unconventional shocks that I mentioned, much more of political interference from governments inside, outside the country, and how to manage then both the communication side, but in the actual decision side, I think it's going to be somewhat tricky going forward. Having said all of this, again, I'm very thankful that you have put this together and having been able to read it, and thank you again.
Okay, so I suggest that Claudio now responds to these comments, and then in the meantime you can raise your head. I will record.
Okay, so can you hear me? Well, first of all, thank you. Thank you very much for the overly kind comments. I won't go through all of them, but just a few points of clarification and so on. Structural factors not important. I'm not saying that they're not important necessarily, but what I'm definitely saying is that it would be useful when thinking about our star, people actually, and the determinants, they also looked a little bit more closely at the data, and they allowed the data to speak. If you think, for example, of demographics, I mean, most of the evidence that we have about the impact of the demographic itself is that, well, you have a model, it basically says demographics is important, and then based on that model that says that demographics is important, you say, oh, look at this. Actually, it seems to be tracing pretty well what's happened to our star. And of course, everyone is doing that. There's a lot of calibration of that type, so our star becomes completely overdetermined if you start looking at those models. So what I'm saying is a lot of the evidence about our star is of a circular nature. You either embed the assumption in the estimation of our star, that's, for example, the Laubach-Williams methodology. You know what is being driven by, plus some unobserved factors. So growth is important in the model, and that's because it's important to the extent that it is there, it's going to be driving it, and then there are some unobserved factors on top of that. Or is of the kind of calibration type that I basically suggested. You assume that the model is right, you calibrate the model and say, assuming that this model is right, then this is basically why it is, why we see what we see. And the other extraordinary thing about most of this, particularly these model type analysis that look at demographics, income distribution, or whatever, is that they're doing it from the 1980s onwards. But they don't they don't look at whatever happened earlier. And of course, since the 1980s, interest rates have been trending down, and lo and behold, they started with a huge Volcker shock. So that's where the starting of the period is. If you go further back and you try and say, okay, let's look at demographics, let's look at income distribution, let's look at growth, actually the systematic link is not there. It is only extraordinary, I was a bit surprised to see it, but actually it is, if there is a robust link, unfortunately, this is what the data show, the link is with monetary policy, which is why I've sort of suggested what I was suggesting in terms of how do we interpret that kind of evidence. Point targets. I think it's whether you have a point target or whether you have a band, it's less important than if you like, your reaction function. And to me, the key of what I was trying to say, which is, again, I don't think is widely shared. But if anything, your reaction function should be, if inflation goes up, then you react quickly and strongly. But if it's sort of a few basis points, 50 basis points, 1 percentage point below even a point target, don't worry too much because it's not going to get out of control. So react less and try to keep your room for maneuver for when time really matters. Modeling framework, sure, models, I mean, we had another model today and so on. Models are, for me, what is more important about the model is the way of thinking behind it. And I think that there is a big difference if you expect the economy to be driven by exogenous shocks that basically then propagate and then the economy then returns to a steady state versus a situation in which you have endogenous contractions and expansions of economic activity. It's a way of thinking. What struck me over the years when I was at the BIS is that when I was talking to macroeconomists, the only way that they could think about the economy working over that period of time, which is against also the history of economic thought, if you like, was in terms of these exogenous shocks. and then the economy would return to equilibrium. So that if you think about the great financial crisis, well, that was either people all of a sudden deciding to, it was a consumption shock, all of a sudden people decided to consume less, or it was a productivity shock coming from nowhere. Well, this is not really what happened. I think it's pretty obvious. But then over time, when central banks developed their financial stability side, then those working on the financial stability side would actually have a completely different paradigm, which is indeed the financial cycle, which has become part of the furniture of economic thinking on that part of the central bank. So you had, even within the central bank, many, and in a vast economy, central banks in particular, I would say like two different schools of thought. Those that were thinking in terms of these DSGE type models, and those who were thinking in terms of this financial, less structural sort of models. And I think what we need is, I think we need to merge those two traditions. So turning to Thorsten now, I hope that's okay. Turning to Thorsten, well, actually, I was not saying that the reason why we had the financial booms and so on was because our star was falling. I was actually saying that it was largely the result of the central bank reaction function. And indeed, the risk-taking channel, actually, it was with a colleague of mine that we introduced the idea many, many years ago. And I remember at the time, actually it was at an ECB conference. I remember that the first reaction that I had to that paper at that conference was, what the heck is this risk-taking channel? It doesn't make any sense. Or in my discussions with Lars Svensson, I mean, it was always really very funny with him. He just couldn't understand that it was possible there was any such thing as a risk-taking channel of monetary policy. I think the risk-taking channel is part of the story, but it's clearly not the whole story. The financial system being broken post-GFC, absolutely. I mean, particularly during what I would call the recovery phase. You had to fix the financial system if you wanted monetary policy to have traction. That's a lesson that we know from history. But my point is that even once the financial system got fixed, and central banks were trying, inflation was at 1.5, 1.7, we've got to get it to 2, and we've got to do whatever it takes to take it to 2. That's the kind of mentality that I think was problematic. Macroprudential policy, well, I mean, again, you are pushing on an open door because, I mean, we developed this macroprudential stuff at the BIS many, many, many years ago. But the problem there is that, at least the way that we thought about it when we were working on it, and again, sort of advocating it when no one really cared, was precisely that you had to think of these two things, monetary policy and macroprudential policy, together. That, if you like, the financial cycle was so powerful that just relying on one of the two instruments to deal with it would be completely unbalanced. It would not work. So my presentation was about inflation targeting, and there are references to macroprudential, but they are in the background. But the key point here is that the two things have to work hand in hand in order to have a balanced response to this financial. And moreover, you do also need the macroprudential policy to be based on a strong microprudential foundation. And actually, what worried me following, look, great financial crisis, G20, the new kid on the block, they basically wrote this wonderful report basically saying macroprudential has to be the way we go. And, for people like me at the BS, that was great, huge success. And then I started having second thoughts about it because I realized that this was giving central banks a reason to say, central banks were becoming increasingly, not enthusiastically, but increasingly sort of shifting to the same, well, monetary policy has something to do with this and needs to be part of the response to the financial cycle, to, oh God, now we've got macroprudential policy, it's business as usual, we can continue doing things as we were doing before. And I think that was part of the issue. Looking forward, you mentioned that there are new shocks that macroprudential policy needs to address. I'm not sure you mentioned it explicitly, but I think it's the biggest issue which has to do, and it's very hard to address, which is basically fiscal, the unsustainability of the fiscal positions. Because, the government is always the the sort of the one who provides solvency of last resort. But if the government itself is insolvent, you're going to have huge problems. And because of a number of reasons, it's very, very difficult to deal with that. But I think that's the next frontier of macroprudential policy. I've written a paper with a colleague of mine on that, but the answers are very they're not clear-cut at all because of this fundamental asymmetry, that fiscal policy is the ultimate backstop to the financial system to start with. And this, of course, is also related to central bank independence going forward. It is going to be a huge problem.
Okay, thank you. So let's start with Steve Cecchetti and Chris Poppa and Michael Kumhoff. And then we'll do the next round. Yeah.
Thanks very much. So first of all, I want to compliment Claudio on actually succeeding in being somewhat optimistic, which I know is not really his natural state. After years of working together, he's trying. You're trying. I think that, and so in that sense, I think that your paper is and your presentation are capable of being read as being very optimistic, which is that this is a good framework, it works, let's refine it in order to make it better, and if we can do that, that would be great. But let me question that. So Thorsten mentioned the problem of populist politicians, and one of the ways of reading what's happened in recent years is that people care not about inflation. Nobody understands inflation. They care about price levels. And when price levels go up, then if you say, oh, I'm inflation targeting and inflation is going to come down, what they hear is something else. They hear that price levels are going to come down because they're victims of price level increases while they are somehow they're deserving of wage increases. And so my question for you is whether or not we've actually formulated the objective properly, given the political economy risks that we seem to face if we actually do inflation targeting. Because it's great to have low inflation, but what's not great is to have inflation that's occasionally high. I think he's going to want to go to a couple more. But
yeah. Chris?
Thank you.
Oh, Chris.
I will join in the chorus of congratulations for Claudio's presentation and very quickly telegraph 4 points across their complement, and I think may even elicit a response. The first one is the fact that there is a commonality. It's clearly that we don't have any competing monetary policy regime right now to basically credibly claim that it would perform better, and therefore it would be a substitution away from inflation targeting. But inflation targeting, being this broad kind of church, does have different flavors. And I will like to recall one that was actually part of the let's say, publications of the BIS, I think about 8 years ago. The idea of more broadly defined and flexible inflation targeting. Now, when we tried to do this in Romania in about 2006-07, in the middle of a huge deluge of forex, essentially lending, investment, and general portfolio investment, that was a problem in itself. And we defined the objective right at that point in time as achieving the inflation goals sustainably over the medium term, but not at the cost of sacrificing any basic macro balance or worsening financial stability risks. And I think that that could be a good heuristic because the temptation to broaden things is there, but there is a limit to how much you can include in this pot that it still makes policy sense and is tractable. That's the first thing. The second one is the friends we didn't make, but we actually lost along the way. I think the way policy formulation for inflation targeting started, it basically spoke about using all available instruments to achieve the inflation targets. We seem to now be fixated on the policy rate. And I would posit that there is a role to be played by a foreign exchange policy and by controversially liquidity interventions, depending on how intelligently these are applied and how they respond to multiple objectives. The third thing would be is that you made a very good point, and this I find is one of the sources of tension and preoccupation for me. monetary policy and an inflation targeting environment makes sense to be formulated, implemented, and then appraised in the medium run. But the temptation is to basically do so in a very myopic short-term setting. And this, coupled with the misbehavior of fiscal and the permanent, it seems, policy challenges posed by fragile independence for central banks, are a source of preoccupation. I don't have an answer for this, but I do have a second thought, which is sometimes the central bank can be seen as too much of a solution. Think of, for example, of the temptation of saying, oh, loose fiscal, the solution is tight monetary. Well, what that leads to is a massive, unsustainable appreciation of a flexible exchange rate, and therefore it creates more risks and more problems for the economy than it solves. So we should be mindful of how we formulate this without pretending that it actually solves the problem outright. Now, my final point is the following. We seem to assume that communication of inflation targeting processes to the public is always appropriate. I'm not saying it's not, but one of the things I'm tempted to favor is that as we move to increasingly complex and less transparent for outside observers models, there is a strong case that central banks should increasingly basically go for staff level projections and risk assessment and leave the board to do what it can do better, which is basically to say, yes, I mean, the staff is saying this, we disagree, we'd like to add more color here, we would reformulate this, and we would basically draw in a broader perspective. Again, thank you very much for the presentation. I think it's a very valuable long-term assessment of what used to be controversial back in the 90s.
Thank you. And now Michael Kumhoff, and then you can respond, and then we'll have another round.
Thank you. I only have one question, but to me it's the the elephant in the room. You were saying that monetary policy determines, or at the very least, co-determines the real interest rate, R star, right? And I completely agree with you. Now, if that is the case, monetary policy makes a big, real decision. That's on a par with what fiscal policy does in terms of making real decisions. Now, against that backdrop, what does that tell us about whether we should or should not have monetary policy independence? Because that was thought about, monetary policy independence was on the basis that the central bank only is about the price level, about nominal variables, etc. But here it's about a real variable.
Thank you. So, Claudio?
Okay. So, first of all, Steve, yes, indeed, this is something that we have learned, or maybe we should have known it from the past, but I guess we're all very young. Think about when inflation was there for the last time, is that people actually do care about the price level, and for them, for at least many people, it's very hard to make a distinction between the two. Of course, financial markets are very good at it, but not the households or possibly even workers. By the way, as an aside, if anything, I'm actually surprised that wages have not adjusted more and regained more of the loss in purchasing power that they have lost, given all of that. My answer to that is that if the implication of what you said is that we should move to price level targeting, because that's what people care about, that's one way in which one could read the statement, then that would actually be over time even less credible for the reasons that we know. You know, bygones are bygones. Once you have to induce a recession because the price level had gone up in the past, I don't think that people will take it lightly. Nothing much may happen to prices, but once the economy tanks, then the central bank would be blamed. So I don't think that can be the answer. So the best, second best, if you like, or third best, is basically to aim for a low level of inflation. But again, with this, you know, to me, inflation is more like almost like a state of mind than a precise number. Is like inflation being low enough so that you don't really care so much about it. Because my price level is going to be different from your price level. As a producer, the price that I care about is going to be different from the prices that others care about, because wages are not going to be, which are the common factor behind many of these price changes, are not going to be that important. So that, I think, is the second best world that we can deal with, or is realistically possible, given how people think about it and what people care. People care about the price level, but they also, of course, care about their employment if their employment disappears. So from a political economy perspective, I think it's very hard, and there are only second best solutions. A number of the big church, yes, absolutely. And I think that if there is one word of what you said that I fully subscribe to, I mean, there are many things that what you said that I fully subscribe to, including this idea that it doesn't need to be just one instrument and so on and so forth, and the role of the exchange rate as well in that context. Of course, with the exchange rate is that to the extent that you're using it, there is the N-1 problem, right? That's the anchor country in the world somehow has to have something which is not based on the exchange rate. But I think that going back, I think what is key is really the issue of the sustainability of the regime. And everything, whenever I think about something, I think what is sustainable over time. And that's why I said, the long horizons being very important in any policy that you put in place. Fiscal and monetary policy, well, that goes back to what a remark I have at the end about not much monetary policy can do if fiscal policy is out of kilter. The question of the issue or the concept of the region of stability that we put forward in the annual economic report a couple of years ago, whereby both monetary and fiscal policy have to be within a certain range, which is, of course, hard to define, if you want to have sustainable economic performance. So yes, and unfortunately, there's not much monetary policy can do if fiscal policy is completely out of whack. And Michael, first of all, there are two ways of answering your question. Well, there are three. One, of course, is that the idea that monetary policy can only affect nominal variables is a little bit of a sort of a straw man. And of course, can be useful for communication purposes, but also one has to take it with a pinch of salt. But quite apart from that, the way in which I was thinking of affecting our star, I don't like the concept very much, but anyway, the way of affecting our star was, look, over time, if you induce a big financial, or if you contribute to a big financial cycle, then you will end up with very low interest rates for very long, in real terms too. And so it's only over a very, very long horizon that you have affected it. Are you changing our star? It depends on your model and your definition of our star. You're definitely going to have, as a result, very low interest rates for a long time in order to revive the economy. The other way of thinking about it is that, well, within a range, as I said, it doesn't really matter when it comes to real economic activity and possibly with inflation. It has a big impact on the financial system. But for the real economic activity and for inflation, maybe you can have interest rates, real interest rates within a range. And that is roughly going to be consistent with different outcomes or the same outcome for output and for inflation.
Okay, thank you. Next, Ricardo, Federico, Maria Cecilia, gentleman over there, and at the end, Anastasios.
Thanks, Claudio, for the presentation. There is now several papers from John Williams, Fed of New York, on R double star. I don't know if you've seen them. So they're doing research saying that financial stability is not in Taylor's equation. So now we're going to create another one, is double star. So different economies, each economist has its own I star. Beauty is in the eyes of the beholder, as the English say. And now there is not only one star, there is another constellation, which is the R double star, which is financial stability. There is an article that has been unshelved after the financial crisis, which is Armen Alchian and Ben Klein, 1973, Journal of Money, Credit and Banking, on the correct measurement of inflation. And that brings the issue that Thorsten raised of whether the Taylor rule has been effective in delivering inflation, low and stable inflation, but whether also has been the cause of financial bubbles. And that's the issue that was raised by Alcian and Allen, who were my professors at UCLA at graduate school. So my question to you, Claudio, is what about other approaches? I know it's difficult to implement the nominal GDP targeting. What's your view on that? And I am a believer that quantities are exogenous and prices are endogenous. And the interest rate, both the whole curve of terms, but also the very short one, the policy rate, is a price. It's the most important price in the economy. It's the price between the future and the present. Shouldn't it be endogenous rather than the instrument of... So what are your views on this?
Yes, please. No, okay. No, so, please, Mario.
Yeah, hi. Thank you very much for the presentation and the discussion so far. My question is whether, so is your analysis really applicable to inflation targeting by all central banks, or did you provide us, or did you share a distinctly European perspective with us? And how would you modify your analysis if you were to speak about central banks, like specific central banks other than the ECB? Thank you.
Thank you. I'll be very brief. I was struck by the things that you didn't say more than by the things you said. And so two of them have been mentioned. One is price level and the other is nominal GDP targeting. The third you have not mentioned at all is climate. Until recently, we had a president of the ECB who said that climate consideration should be part of the primary mandate of the ECB, so potentially overhauling entirely the inflation targeting framework. I'd love to hear you on that. Thank you.
Okay, so I think... Okay. Okay, so that's it.
Okay. Okay, R double star. If I recall, the paper on R double star had to do with... it depends very much on the kind of model that you have. And in that particular model, the R double star had a very sort of short-term focus on it, to it. It was the idea that if you have problems in the financial system, your interest rates has to be even lower and so on. Look, again, I would rather try to move away from this idea of R star. Let me give you another example. It all depends on how you think the economy works. Larry Summers used to say that the R star was very, very low. And that very, very low R star was creating bubbles. It goes back to some of the... And that was creating, you know, problems longer run for the economy. Now, to me, that statement is almost a contradiction in terms. If you think that R star is generating bubbles, if you think that that is having a big impact on the economy, a destabilizing impact on the economy, then of course you can say that that R star, in terms of how it is normally defined, inflation and output period by period, then that's okay. But over time, it means that it cannot be an equilibrium rate, because it is just generating a huge disequilibrium in the economy. So that goes back to the point that what R star is ultimately depends. You can always define a concept which is R star, which is all else equal, conditional on all the other things that are there in the economy, is going to help you to reach your objectives. Fine. But that, to me, is going to be very, very difficult concept to define. It's going to be so model dependent that it's not going to be a particularly useful guide to policy. The Alcian article, yes, I remember reading it. It was about redefining the price index to include asset prices. Yeah, exactly. So it's redefining the price index and so on. I think that from an operational perspective, that would not be particularly helpful, because the properties, say, the properties that property prices have, for example, are very, very different. Statistical properties are very, very different from the properties that the normal price level has. And if you are going to be including that as part of your, index, you're going to likely generate a lot of instability in the economy. That's why I am sort of more of the view that it's better to take what I call these financial imbalances into account, symptoms that the economy is out of whack, and the financial side, including in that context property prices, which are actually key, is going to come back and haunt you further down the road from what your typical policy horizon. Nominal inflation targeting, maybe, but what I don't like, I don't think that typically when one talks about nominal inflation, nominal income targeting, GDP targeting, and so on, one is thinking of bygones not being bygones, and if you add that to your system, if you think of that as nominal GDP targeting, I don't think that those approaches are credible for the same reason that price level targeting is not credible. I think that in general, the idea of giving more relevance in your framework to nominal variables and nominal quantities, in addition to interest rates, as a guide to policy, is something that I think is worth exploring. That's why I think that things, going back to what you used to have at the ECB many years ago, thinking of the role of monitoring credit aggregates, somehow bringing those into your system, your way of thinking about it is important. And this also ties into the question of, is what I have explained very much something for advanced economies? Yeah, I would say that emerging market economies have also other issues to deal with that have to do with the foreign currency liabilities and so on and so forth. And that means that I think all else equal, they're going to be given more weight to the exchange rate than advanced economy central banks might, all else equal. And I think that's relevant. And I also think that the way that I tended to think about the whole thing at the BIS was so much we needed to think more of what we call a macro financial stability framework. I think the IMF, I don't know where John is, talked about the integrated policy framework, and it's that kind of thing. You need to think of a variety of instruments to help you achieve longer-term sustainable balance. Climate, I definitely would not add climate to monetary policy as an objective. I think that also from a political economic, if that is what you suggested, because from a political economy perspective, if anything would not work, I think central banks should have as objectives things that they can actually have a strong influence over, and they have the right tools to pursue, and they don't get them into too many sort of complications, political economic issues, and I think that climate change is one of them. That's different from saying you've got a financial stability mandate and you take climate change into account to the extent that applies to your mandate, or you've got an inflation objective or whatever other objective, and you will take that into account in your policy decisions. That's perfectly fine, because it's to the extent that it influences what you're responsible for.
Thank you very much. I think we've had a fantastic keynote session. Please, let's thank Claudio and our discussants. We should be back in 15 minutes, right?